Hey guys, and welcome to Money Talks News, the podcast. Today we're going to talk about the stock market. Getting a little freaky out there, isn't it? The market went up this summer, but boy, it is coming crashing down now. And interest rates going through the roof, higher than they've been in decades. Are you a little nervous? If you're not, you must not be paying attention. We're going to talk about that today and see what, if anything, you should be doing with your stocks, bonds, and everything else. I'm Stacy Johnson. My co-host is Miranda Marquit. Hello, Miranda. How are you doing?
I'm doing just fine. You mentioned not paying attention, and now I've had to go and pay a little bit of attention. So here we are.
And we also have our producer and novice investor, Aaron Freeman. Hey, Aaron.
Hey guys. How you guys doing?
I'm doing well. And today we also have a special guest, Jason Vitug. I said that right, didn't I, Jason?
Yes, you did.
Jason Vitug, and who's actually known as the maestro of happiness. Well, he's known that way now because I just made that up. But anyway, Jason's here with us today too. Jason, are you a big follower of the stock market? We did a podcast with Jason on happiness, but he also pays attention to the stock market. That's true, right?
I do pay attention to the stock market, but very limited way, so it doesn't affect my happiness. just what we're seeing daily.
Good
so
for you.
Yeah,
good for you.
Yep, I have boundaries. I've created boundaries when it comes to the stock market news.
Yeah, and I'm on it constantly. I mean, I'm looking at the stock market constantly. I have 30 different stocks, maybe more than that actually, and I've been doing it for 40 years. Let's put ourselves in perspective here. It is September 21st, 22nd? 22nd.
Yes, it is 22nd. Yeah.
And the market has been going down lately. And by the way, should we mention specific investments in this podcast, and we probably will, do not take those as advice. We do not give financial advice. You know why? Because we don't know you. You have to do your own research, make your own decisions, take care of your own money, folks. Okay. So now let's talk about where we are and where we're going. Did you guys have any idea that interest rates were going to go up as much as they have this year?
I don't think we had an inkling of it. I mean, everybody's been saying so, but you don't know if it's actually going to happen.
Yeah, I mean, it's astounding that right now. And in fact, I was talking about this before we went on the air. If you get an ad for a CD that's promising you 3% for 1 year, throw that ad away because you can get a Treasury bill, which is even safer than a CD. I mean, it's basically the same thing, both guaranteed by the government, paying 4% 1 year. You haven't seen interest rates like that, and I don't know when. Certainly more than a decade.
Yeah, we're definitely moving into kind of a savers market, if you will, right? It's been a long time since savers have been able to go through and see some competition for higher rates. So this is really kind of a savers market right now. It's not
last week, Miranda, I bought a Treasury ladder, which I've never done. I've never bought a Treasury bond in my entire life. I'm 67 years old. I've been investing for 40 years. Never bought a Treasury bond in my entire life. And so I bought last week a Treasury bond ladder. It's actually bills. You know what a ladder is? Everybody know what a ladder is? It's buying different maturities of bonds. So in other words, I took 40 grand. I put 10 into a 3-month T-bill, 10 into a 6-month T-bill, 10 into a 9-month, and 10 into a 1 year. The average of all those, the interest rate was about 3.8%. It's better than that now. I did this 10 days ago. And so that's the first time I've ever done that. It was real easy to do. Sounds complicated, but all I had to do was go to Charles Schwab, push a button. I wanted a ladder, 1 year ladder, blah, 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 and it made it. Just like that. But the point I was going to make was, though, I locked in 4%. And guess what? That day that I did that, the stock market fell 4%. It fell 4% in 1 day. Well, I locked in a 4% risk-free rate.
That's good.
So that's competition for you.
So back when we first started doing these stock market updates and you guys got me all excited about buying stocks, so I put about 17 grand in. I'll say the numbers. I don't care. And I've lost 6.
You haven't have you lost it? You sold?
Yeah, no, I lost 6 so far because everything.
Did you just sell it?
You're down 6.
You're down 6.
I didn't sell it.
Yeah, you haven't lost it until you've sold it.
No. I mean, it's down. I'm down 6 grand. No, I have not lost it. I still in that. I don't sell. So now I've turned into Miranda. Like if anybody listens to this, Miranda's like, oh, I just index and buy trickle here and there. So now I've switched to that. Like now I only buy.
You're just an indexer.
No, just
What about you, Jason?
Yeah,
You're an indexer?
I actually repeat. I have a mantra when it comes to the stock market: DCA.
That's
and
right.
just dollar cost averaging just to keep my mental peace. And yeah, so I have a core and explore strategy when it comes to my investing. It's a core of it is through index funds, and the explore aspect are really companies and stocks that have long-term business models and growth. So that's how I've worked my strategy around it. And so I went to your point, Aaron, seeing I have this one account where I was buying stocks just because it was the thing to do a couple of years ago, and I haven't touched it. And so I looked at this app a couple months ago, and just recently, about a week, and it is down $11,000. And so in my mind, I go, okay, do I buy more into these companies, or should I just kind of step back and see what happens in the next couple of years? But that's when I realized I'm like, yup, I am an investor, not a trader. So
yeah, I'm an investor too, and I own almost exclusively stocks. I do own some index funds, and I realized, by the way, that I was going to call you guys wimps for just being index fund investors, but that's not true. Obviously, in fact, books that I've written, Jason, I've always said, you take your H100, you put that percentage in stocks, you take the rest and divide it equally into money market and short-term bond fund. That's what I've said.
We did get the I bonds that we talk about, though.
What's that?
We did buy I bonds, though.
I didn't buy I bonds.
The ones
we talked about it.
They were at about, what were they? Almost
9.6. You bought them, you said.
Yeah.
Oh, good for you, man. That's smart. But and by the way, I want to be real clear too. I'm not suggesting everybody go into the bond market and get out of stocks. Do not. In fact, my opinion is, and that's what this whole podcast is about. Do not sell your stocks here. Is the market going to go lower? Absolutely. I'm convinced of it. And right now, the S&P 500 is 3766. I believe it's going to go down to 3,300. 3,600 almost certainly, and 3,300 possibly. But then stocks are getting on sale. This is when I'm going to start buying them. Okay, so I would not be a seller of stocks here. I would be a buyer gradually, as you guys do, dollar cost averaging in here. That's the way I'm looking at the market. Miranda, what are you thinking?
So kind of the same thing. Like Jason, I have my core strategy is to invest in index funds and keep that going. And then I do have like my play money, and I run weird experiments and do things like that. And so the experiment side is suffering a little bit more. And part of what I do now too is look at this experiment side and say, okay, do I fundamentally like what I have in the experiments right now? Is now a time to do a little tax loss harvesting? Is now a time to sell some things while they're down, take that cash and go ahead and take that loss from my income or offset some of my capital gains and just kind of take advantage of that. So I'm also looking at that as well. So I look into my kind of what Jason calls his explore and what I call my like fun, weird experiments. I look at that and say, okay, is the experiment done now? And is it time to take those losses and use them for a tax advantage? So that's another thing to think about right now too, is now a good time to reposition some of your portfolio? Does it make sense? Don't do it out of panic because the market's falling. You want to do it, okay, let's look at my strategy. Let's look at where we're going. Let's look at our goals. Let's look at this money is supposed to accomplish. Does it make sense to reposition myself and take some of those losses, go ahead and lock them in, and then get that tax advantage? Like, how does that fit in there? And you can talk to somebody, talk to a financial professional about those options and what you can do to better your financial position, even if you are selling at a loss.
Yes. Yeah, that's true. But you know what? I just remembered something. I just this morning finished an article that hadn't been published yet. I just pulled it up. And it's 3 mistakes that I have made. 3 mistakes nearly every investor makes is the title of the article. And the 3 mistakes are not buying when stocks are on sale. And this is something I've done and other people that just about everybody wants to do. You see, you're down 17 grand or 6 grand, whatever it was that you said, Aaron. And now you're like, screw this. I'm out. You know?
No, that's not what I'm doing at all. But go ahead.
I know. Well, okay, you're not, but people do this. Right. They're discouraged. And, it's funny because when something's on sale at the mall, they're piling in the car. But when stocks are on sale, they're freaking out. And you ring the register when stocks are at their highest. You become wealthy by buying stocks when they're at their lowest. Yeah. So I look for situations like this. I'm happy the stock market's going down, even though I've got a ton of money in it, because I know that I'm going to be able to make money when it comes. And key thing here, I don't have so much in the stock market that it's making me lose sleep. I did. And I sold about a third of my portfolio in late August because I thought I'm convinced the market's going to go lower.
Right.
And I didn't want to freak out about it. So now I'm happy when the market's going lower, even though I've still got a lot of money in it, because I know I'm going to be buying stuff as it goes on sale. And I'll be specific too. I'm looking at Google. I'm looking at Microsoft, both of which I already own. And I might even add to Apple. I own Apple too. And there's some other stuff too that I may be looking at. The quality stuff held on to for long periods of time will make you rich. Just that simple. And so that's why I'm looking to buy that quality stuff at lower prices.
We've talked about the S&P 500. You and other banks have said that's going to go down to 36 and then drop down to 33. What about the dividend ETFs out there that everybody's saying those are fine? Those companies are still pretty strong.
Dividends can give you a floor to an extent. Now, in other words, for example, I'm trying to figure out how to say this as fast as possible. If a stock is $10 and pays a $1 dividend, it's paying 10%. It's unlike if that stock goes to $5, it's still paying $1. Now it's paying 20%. So because the stock pays a dividend, that can often establish a floor underneath it. So it won't drop so much because the yield is so high. Now, the problem with that is that when interest rates are going high, I just told you I'm earning 4% on 1 year T-bill with no risk.
Right.
So that means that dividend that I'm getting from that stock isn't worth as much as it used to be, because it used to be that T-bill was paying 0 or 0.1. Now it's paying 4. So that dividend is not going to keep me in that stock as easily now as it would have when I had no place else to go for yield. Does that make sense?
That makes sense. Don't companies usually raise their dividends though during these times to entice people to buy? Well,
companies try to raise their dividends every year.
Yeah, I mean,
what are they called? Dividend aristocrats?
Yeah. So dividend aristocrats are companies that have raised their dividend every year for at least 25 years. And then there are also dividend kings that have done it for more than 40 years. And so looking at those, I like to have one of my index funds is a dividend aristocrat fund that focuses on those dividend aristocrats who are, there's no guarantee that they'll keep raising their dividend every year, but there's a very good chance that if they're already on the dividend aristocrat list, they will likely continue even during a recession, even during a stock market crash. Even if it's not a huge increase to the dividend, they'll keep raising that. And I do like having a dividend index product in my portfolio as part of that.
Cool. And we also need to remember that a stock market is a market of stocks. For example, I own a bunch of oil stocks, which I've owned since 2009, and so I'm kicking ass with those. So there are stocks that pharmaceutical companies can do well. So just because Microsoft's going down doesn't mean everything's going down, or Apple. So let me do this, you guys. Let me take a quick break. We don't have a whole bunch of time left. Take a really quick break. And when we come back, I'm going to give you guys some time to think about it, because I'm going to ask each one of you, if you had to buy a stock tomorrow or this afternoon, which one would it be? Okay, you think about that. We're going to take a really quick break. Well, now that you've had a lot of time to think about it, so guys, tell me if you were going to buy a stock today, which one would it be? Aaron?
Oh, really? Right on the spot? A single company?
Yes.
I don't know. You can always go with a safe play of Apple. You hear
That's not bad.
I keep hearing that this thing is going to become a bank at some point. So I don't know. It's possible that could go through the roof.
I sold a lot of my Apple, but I still have a ton left. Okay, Jason, one stock.
Meta. So
awesome. I own Meta. Yep. And actually, I bought Meta. The only thing I bought this summer was I bought Meta. And it's underwater from where I bought it. I paid $155. It's like $140 now, I think. And then I bought Eli Lilly, which is doing well.
Yeah, I bought Meta or Facebook back in 2020 and sold it for a good profit, and then hit myself over the head because it continued to move up to like the $300 range. And I'm like, oh, I should have held on to it. And now that I'm seeing that it's dipping below the amount that I sold it for, so it's a buying opportunity.
That one hasn't split, right?
Yeah, I think no. It's risk. It's split. It's half what it was, if it hasn't split. But it's and that's a risky one, going into the metaverse. And I'm not. I vacillate on. I own 200 shares of it, and I've thought about buying more, but I'm not sure if Mark Zuckerberg. He's obviously a very bright guy, but I'm not sure if he's out over his skis on this one. We'll see. Okay, Miranda, you've had all the time in the world.
So if I was going to pick a stock to buy and then kind of hold, I'm looking at Disney. DIS, I'm looking at Disney. They are this entertainment juggernaut, and blockbuster after blockbuster, streaming service. They've just got their little fingers, their little mouse hands in everything. And so I looking at Disney and their recent quarter three earnings beat expectations. And there's just a bunch of things there. A lot of people were looking at okay, this surprised everybody. And the parks are coming back. People are going to Disney again, and Disney's on my mind. I actually just went to Disney a couple weeks ago. I went to Disney World and a VIP tour, and so that made me happy. But yeah, so I'm just looking at Disney and I'm going, okay, they're beating expectations. The parks are coming back.
This is a great time to buy Disney.
Yeah, and so I'm just like, Disney, okay, let's do this. Well, I mean, I'm
in
not
Disney
at about this, but
I think I paid $140 or $160. I'm at Disney. Disney's 102, or almost 103 as we speak, and I paid at least $140. I mean, I'm way underwater on it. But this is a type of stock I like to buy though. There's no way this company's going out of business. It owns its brand, right? It has a moat around it that cannot be breached. I mean, this is a company that, and same with all the companies I like, Alphabet or Google, whatever you want to call it, Apple, Microsoft, because these companies can go down, but they ain't going out. Sooner or later, they're going to go up. One of my favorite expressions that I made up many years ago was if you think that the stock market is going to ultimately rebound, or let's say the economy is going to ultimately rebound, then buy quality and hold on to it. If you think the economy is not going to rebound and it's going to go down forever, then buy a shotgun and canned food. Because the economy ultimately is going to come back. And as long as you live long enough, then you're going to be rewarded if you buy.
I think another thing to look at would be semiconductors. The world runs on them, and right now the world's in turmoil, but it won't always be. Sometimes you can watch just gamers in general have slowed their purchasing of games and gaming machines and all kinds of things. A lot of that is due to everybody saving money because we're living in a high interest world. But as soon as that starts leveling out, everybody's going to need these things again. And once those lines open up, all that stuff's going to go back up.
Yeah, I think so too.
So
go ahead, Miranda.
I'm looking at my phone now and I'm buying some Disney. So thanks for that. But I was going to say, I just kind of to your point, Stacey, I was talking to a friend the other day and he was just like, man, my stomach can't handle this. It's dropping. My portfolio is dropping. My stomach can't handle it. He's like, I got to sell something and just move it into one of these high yield accounts before I lose even more. And he's like, I'm leaving my retirement accounts, my tax advantage retirement accounts. He goes, I'm going to leave those alone. I know those are a long term, but my stomach can't handle this in this smaller account. And so I am going to go ahead and sell. I'm like, great. If you're selling at a loss, make sure you harvest those losses while you're at it for that peace of mind. But I said, remember though, eventually that stock market's going to go back up. Our society is built around this. And if the stock market ever doesn't recover, we've reached a point where money doesn't matter anymore. Right. And we have bigger problems to think about. Right. And once again, and I did say, then we have bigger problems to think about. And I'm glad I'm armed. So yeah.
I mean, this is literally a gut check. If you're staring at the ceiling at night, you've got too much money in the stock market. Just that simple. Like I said, I'm watching the stock market go down every day. I predicted it was going to go down. It's going down, and I've got a ton of money in it, but I don't care. And the reason, but guess what? A few months ago, before I sold a third of my portfolio or a quarter of my portfolio, I did care. And so that's what let me know I got too much money in the stock market. I didn't want prices to go down because it hurt too much. It was bothering me. And if that's you, folks, whoever's listening out there, if you're worried, you got too much money in the market because what you want is for stocks to go down, and you want to have some money on the side so you can buy more.
I like that. I think it's powerful to kind of reemphasize what you just said, because if you are stressing about the daily market fluctuations and you do have too much of your money in the market and you don't feel secure, and you definitely have to reassess how you're allocating a portion of your portfolio and different investment vehicles, and so I think that is key. You know what else I want to buy, Miranda, is Costco.
Oh, yeah.
I've never owned that, and I missed that. I also missed, what's it called? Netflix. I remember when it was, I think it was 40. And it wasn't that long ago, it seems like. But now it's 300, or is it 250? What is it? Let's see. I think it's 230 or something like that. But it was 600 during the pandemic.
I was going to ask you a question, Stacy. So we've actually read the same thing. So I've heard from Bank of America, Deutsche Bank, and from all these smart people that, hey, the market is most likely going to go down. And they said, nibble a little bit at 3,600 on the S&P 500. And definitely when it hits 3,300, buy a lot. With that, all these smart people and you, how much is already priced in? How much of the sell-off is already priced in to the point? It was like, how true is this? Because the market doesn't always do what all these professionals say.
Yeah, you're absolutely right about that on both things. A lot of this is priced in, and the market does whatever it needs to do to disappoint the greatest number of people. That's always the case. So if everybody's saying 3,300, that's one thing it ain't going to do. You know, what it is going to do. And by the way, I wouldn't say buy at 3,300. Depends on what's going on at 3,300. Right. You know? I mean, like, we all agree that interest rates going from literally 0 to 4 in less than a year, way less than a year, like less than 9 months, has never even happened. Nobody saw that coming. Nobody saw the pandemic coming. Nobody saw the housing crash coming. Well, if some people say they did, back in 2008. But you know what I'm saying? It's like there's going to be a problem. So I'm not going to say today what I'm going to do 2 months from now. Because actually, Aaron, when we were doing our stock market podcast, I was saying I'm going to be buying all summer. But the stock market started going up in June and kept going up until August. And I didn't think that was right. So I didn't buy. I said I was going to, but I didn't because the situation changed. Right. I thought the stock market needed to go down. And then when interest rates, went up to 4 on a 1 year, I did something I've never done in 40 years. I bought a T-bill. And so I'm not going to say what I'm going to do in advance. I do think the market's going to go lower, and I do want to start buying pretty quick. In fact, I wouldn't mind buying something right here. The S&P's at 37.
Well, that's what I've been doing. Every time I
wouldn't mind nibbling at Disney or Google.
Every time I see a massive dip, I'll buy a few stocks. Goes up, I see a massive dip, I'll buy a few stocks. Because, there's always the upside, right?
I think though, one of the things that Jason and I were talking about is we stick with our plan. No matter what the market is going, we're still putting that dollar cost averaging in. I have the same amount of money that goes into my index products, regardless of what's going on with the wider market. The thing that changes is the extra money that I have. Okay, when do I deploy to buy extra money as the market's going down? When does it reach a point where I go ahead and deploy that extra cash? But I don't change the core of my strategy. The dollar cost averaging keeps going. I keep buying putting the same amount of money in regardless of what the market's doing. It's the side money that I do something else with. But I don't change my plan. I don't change my overall plan or strategy due to the whims of the market.
Yeah, well, you guys remember me saying this when we were doing stock market podcasting. I say, like, when times get tough, don't adjust your portfolio, adjust your expectations. Stop thinking you're going to make 30% a year when you might lose 20% this year. Just get used to that idea. As long as you've got the right strategy and the right long-term goals, you're fine. Just adjust your expectations. Don't freak out.
Absolutely. To my my core strategy of that dollar cost averaging, that gives me peace of mind. And that peace of mind allows me to buy the dips, that my explore part of my investment strategy. And so I know that people like to chase the highs. They're going to like, okay, this is just going to keep moving up. And I like to buy the lows. And so whenever I hear news of companies such as Disney and Netflix and Microsoft, when I hear bad news, I'm like, oh, that's an opportunity for me to go in. And so that's the explore part of it. It's like, I'm going to explore this opportunity to grow my individual stock investments into these companies. And I think that's important for people, and especially for me. When I think about like happiness and I think about peace of mind and less stress, is I have something that's working for me where I'm not at the whims of the daily market fluctuations, but also becoming a better investor. I do take advantage of these dips. And like you, Stacy, I do think it's going to go down. And what I do is that I price that in terms of these specific stocks that I have my eyes on, not the high risk and potential growth. I look at the companies that have stability. And so whenever there's an opportunity, whenever I hear these bad news, I go in there and I have my extra money on hand to go buy these shares.
You know what? I never say I'm smart. I've done this for 40 years. Never smart. Experienced. You know, the reason I bought stocks when the market sucked in 2009 is because I've been standing on the sidelines like a deer in the headlights when other recessions happened, and I didn't buy, and I hated myself for it. You know, so it's not that I'm smart. It's just that I've been around this block a million times. And so, you know, take my advice, buy stuff when it's low and hold on to it, but buy quality, because otherwise, you know, you could lose everything.
Did you get to explain why it benefits to do the ladder and the bonds that you bought, the T-bond?
Yeah, the reason I did that, Aaron, is because I don't want to tie up my money, which is kind of stupid because I have enough so I could tie up some of it. But I always want to feel like I have money liquid. So when I've got money, let's say interest rates continue to go up. Okay, I locked in a 3-month T-bill, 6-month, 9-month, and 1 year, right? So if interest rates have gone up since I did that a week ago. So, but now if interest rates keep going up, I got something coming due in 3 months that can capture those higher rates. And then another 3 months, and I can capture more higher rates. And if interest rates go down, at least I got something locked in for a year, right? So the reason is because you always have something coming due, so it's more liquid. And if rates are rising, then you're going to be able to capture higher rates. And if they're falling, at least you've locked in some. Now, when I think rates are done rising forever, in other words, when we get into a recession and rates start coming down, I'm going to go out and try to buy a 5 or 10 year, because that will go up in value as interest rates drop. So I can sell it for a profit.
I have a very similar strategy. I have to try your bond ladder. I do a certificate ladder strategy with financial institutions. Yeah, same thing, same concept. I have 30-day, 3 months, 6 months, 9 months, 12 months. So they're constantly when they mature. And I've noticed as well too. I think the last time I looked, it was up to like 2% on average among all these different strategies. And that for me was peace of mind to be able to access cash when I needed it, if I need it. And so, diversified, peace of mind. So I'm going to look into that.
But this is a rare situation, Jason, where the 1 year is paying 4% and a 1 year T-bill is paying 2 or 3. I'm sorry, 1 year CD is paying 2 or 3. It's rare that treasuries pay more, that much more especially, than certificates of deposit from a bank. So I would urge people to look at those. And it's real. Like I said, I've never bought them my whole life. It took 5 minutes. I thought it was going to be like, oh, geez, can I buy them through this? How do you buy them? You know, I thought you had to go through Treasury Direct. Is that what it's called, Miranda?
Yeah, that's called Treasury Direct.
But I just went to Schwab and they said, "You want to buy a bond? Here's a ladder." I'm like, "Oh, okay."
Yeah,
it was.
Yeah, the brokerages are, offer it. You're going to pay a bit of a premium when you go through the brokerage, but
can I go to the bank and buy T-bills?
Some banks do. Yeah, you can get them through.
I think regular like Wells Fargo, big commercial banks.
Yeah, you can
buy
get
T-bills
banks
for them, right?
T-bills for them as well, and then you can also go to Treasury Direct and .gov, and you can do that as well. So and make your own.
Some financial expert I am. I'm asking you how to buy T-bills.
But it makes sense though. I mean, if you want to, trying to navigate Treasury Direct is kind of a pain in the butt.
I was going to say when we
I did this. They sent me a form.
Setting up your own. Yeah, and setting up your own ladder can take more time. If you can go to your brokerage and pay a bit of a premium and click a button that sets up a ladder for you and do it very quickly, now you've bought now you've bought some time back for yourself.
And I'm going to end with a little warning about Treasury
Yes.
Direct. When we bought the I bonds there, you have to be very careful when you set up your bank for the first time. If you do not set your bank up the right time, the correct way with Treasury Direct, you won't be able to do it again. They will. Yeah, and
But this happened to
they'll
me,
send you a
Aaron.
message saying
I
that you
tried
now
to set
have
it
to
up
go to your
online.
bank and you have to get a written letter and you have to mail it in to get everything corrected. And it's
No,
like,
they
what
did this to me.
So you got to be very careful. Yes.
Did that happen to you? That happened to me. They sent me a form. No, I had to download a form from the web, and then I had to take it to the bank to get it notarized. And I sent that in.
Yeah.
This is 2 months ago, and I still can't buy it. That's why I started looking to see if I could buy them from Schwab.
Yeah,
because
it's not
I
a great
couldn't
website, and
use the thing.
their help section really doesn't coincide with what's on the screen. They'll show you things. They'll have definitions in the help section that don't correlate to what's on the web page. So if you're trying to buy bills or bonds for like family members and stuff like that, it gets very confusing. The terminology is really bad. So just be careful when you're on that site. I
Trashing
didn't like
Uncle
it.
Sam. That's how we like
didn't
to
like it.
close our podcast. Anyway, we do not like treasurydirect.gov. We are out of time, folks. We are never out of topic. That's why what you need to do is you need to dig a little deeper. You're going to find lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is mirandamarquit.com. And of course, you want to visit Jason and his website. Now, I'm going to give you this. It's called frugal.com, but it's spelled P-H-R-O-O-G-A-L. Frugal.com. If you got a question, comment, or topic you'd like to suggest, we'd love to hear from you. Email us, hello@moneytalksnews.com. That's hello@moneytalksnews.com. And one final thing, if you like what we do, then do something for us. Subscribe to our podcast. Takes you a couple seconds. Really helps us, though. So if you like us, show us. Tell your friends, and also have them subscribe. I'm Stacy Johnson.
I'm Miranda Marquit.
I'm Aaron Freeman.
I'm Jason Vitug.
Jason, thanks for being with us. And thank you guys, everybody, for listening. We're going to see you right here next time.